All right. So my next guest has been along large cap technology names. And last time he was here, he actually shared Samsung, Amazon. In April, he gave us Micron, up huge. With me now, Federated Hermes, Deputy CIO of Equities, Steve Chiavarone. And Steve, so this year, obviously, we've seen the most expensive stocks. Now, these are your enterprise value to forward sales, expensive from Wall Street standards, but they've also been the best stocks, right? Whether it's Marvell, AppLovin, KLL Tencor. We see these names that have gone absolutely through the roof. And then the cheapest stocks have somewhat struggled. A lot of healthcare names over there, United Health,
Yeah.
So it's been sort of flipped upside down. You've been in a lot of these red names. What are you doing right now?
We're sticking with it. Look, here's the story. You have this generational infrastructure build out, and it's built on chips, and it's built on all the infrastructure that's supporting AI. These shortages are real, and they're going to take years in order to work through. So we think that these stocks, for all the talk about their valuations,
Right.
what you're not talking about, not you, but the market generally, is that earnings are also exploding, right? And on a net basis, a lot of these names have derated. Look at a company like Nvidia. It went from 60 times earnings just 3 years ago to 20 times earnings while exploding higher. So we think there's legs here. What I would say, though, is I think you're going to see some weird moves in the market over the summer for some of the things that you talked about on the open.
Right.
There's just some forced selling and some forced rebalancing.
What about, so for a while you were looking at 2 rate cuts. I think you guys are modeled for 2 rate cuts. Now the street, we'll pull up the table here. Now the street's modeled in the dark black, folks. Those are rate hikes. The street looking for 2 rate hikes this year. Is that adding some of the anxiety to this market? Is that adding some of the worries to the market right now?
So it pains me to say the first part of this, which is the chances of the Warsh Fed hiking twice this year are slightly worse than the chances that I'm going to be selected to name the next James Bond. And I really want to, Charles.
Though, from here up, though, you got it, my man.
What's wrong down here? No, no, but the point I'm making is that, look, if you hike rates, all it's going to do is hurt that bottom part of the K, right? The housing market's already in recession. Low-end consumers are already under pressure. The inflation we're seeing is about oil. I don't think rate cuts helps that, and I think this Fed is going to understand that.
I do. I know Warsh understands it. He's got to communicate with his fellow folks there. All the things we spend a lot of money on, insurance, auto repair, all that stuff. Rate hikes just makes it more expensive for us to pay those bills. Let's talk about areas that make some money. You like Manpower Group. It's been trading sideways all year long, actually going back to next year, but it looks like it's formed a base here. What's happening?
So another story that I think is just becoming in people's mind forefront is that we only added 10,000 jobs a month last year. We're running at 180,000 jobs a month this year.
Right.
You've seen a big pickup in employment. A lot of this is about that infrastructure build out. Manpower supplies temporary and permanent workers to the economy. So if you've got a big pickup in employment, this company was pricing in no one ever getting another job ever again because the robots were coming.
Right.
I don't think that's quite going to happen, and I think if you're going to do $600 to $800 billion of capex, you need somebody to hit the nail with the hammer.
2 Fed meetings ago, Powell actually answered the question and said he wouldn't be surprised if that was the case, 0 job growth. So to your point, these have been some monster moves. You also like Mickey D's here. What's going on?
If you have job growth of 180,000 a month and wages are growing 3.5%, and we're seeing the biggest declines in unemployment coming at folks with some high school education, some college education, or no high school education, that bottom end of the K, that consumer, I think is going to pick up. It's going to perk up. And so that meal at home becomes a meal out. McDonald's, great company, multi-year compounder, well off the highs. This is a contrarian play on a consumer. We think that's going to surprise the upside this summer.
All right, then finally, Nvidia.
Yeah.
You kind of already referenced it. Now, the good news is that it has been trending higher.
Yep.
Right, and it's right at that 50-day moving average. It's so crazy because Jensen Huang is like he's the kingmaker. If he says I like XYZ stock is up the next day. But his own stock, it's like physician, what's going on with thyself? What is it going to take to really get this bad boy moving?
So I think realization that if you're going to do $600 to $800 billion of additional capex this year, and then you've got the likes of Google and Meta doing capital raises to do more capex. 2/3 of the cost of that capex are the chips. And there are no better chips out there than Nvidia. So you've got people that are using kind of second and third rate chips right now because it's all they can get.
Right.
They're going to want to upgrade. And I think that this name has spent enough time consolidating and is ready for a breakout.
You know, it's amazing. If you look at first of all, the CUDA system, right? That's their platform. And then they're calling the shots with the new racks, with the Rubens. I mean, it's just, they are calling the shots, to your point, and everyone's raising money so they can buy their chips.
You got it.
Good stuff, my man.
Thank you, sir. Great to see you.
All right, Bond, take it easy. All right, folks.